Dividend investing can be very desirable for retirement investors and people seeking passive income in general, because it's income received on a regular basis. Investing for dividends entails purchasing companies that have decided to distribute a portion of their profits to shareholders. Think of receiving cash flow from dividends as similar to receiving a paycheck, except that income continues to come in passively with no effort. For simply owning an asset, payments are dispersed on a regular basis with a high degree of stability in relation to other investments. In other words, once the asset is purchased, the dividend payments will arrive automatically and continue to come in, assuming the company making the payments continues to do well financially. This is why so many retirees and passive income seekers enjoy this strategy instead of purchasing for solely capital gains. My name is Chris, and I'm here to teach people about money, personal finance, and investing. If you're interested in improving your financial situation, make sure to subscribe to the channel. There are generally two ways to generate income through stocks and other forms of investments. One is capital gains, which is profit received by purchasing an asset at one price and selling it at a higher price. This method is what's most commonly thought of when it comes to investing. For example, a stock purchased for $20 and later sold for $40 leaves the investor with a $20 capital gain. The second method of generating income from stock investing comes in the form of cash flow or dividends. For example, a stock purchased for $100 which pays a dividend of 3% or $3 per year. Furthermore, the price of the $100 stock is likely to increase slowly, perhaps to $110, which provides a small amount of capital gains as well as the dividend income. While each strategy has the potential to provide great reward, capital gains can be seen as less desirable for multiple reasons. Cash flow is a more continuous and stable investing strategy. Whether you're buying rental property for cash flow or stocks for cash flow, this type of income tends to be more stable during rough markets. During the Great Recession, when the price of nearly every stock plummeted, healthy companies such as Johnson & Johnson, 3M, and Coca-Cola were able to maintain their dividend payments despite their share prices temporarily dropping. This is because income stocks are typically more mature, stable, and slower to grow and expand, contrary to growth stocks like Amazon, Facebook, and Google. Like dividends, rental income from apartments and homes tend to fare best when compared to non-cash flowing properties. During market downturns, fewer people will purchase their own property and rent instead. This could be due to loss of job, reduced income, higher uncertainty, or more stringent lending requirements, resulting in a higher demand for rentals. After all, do you think it's more likely that a rental property is going to appreciate steadily every month over the long term, or is it more likely to provide a steady cash flow? Keep in mind that rents have historically held strong when property values were declining. The same trend happens with income-producing paper assets. The general sentiment among investors tends to lean away from high appreciation, speculative growth stocks. Investors who are once enjoying capital gains income start looking for dividend-paying investments or somewhere where their returns are more guaranteed when the market underperforms. This is because dividends and other cash-flowing assets are less susceptible to volatility. In theory, you'd never need to sell an investment when receiving cash flow. An investment can be held as long as desired when it produces cash on a regular basis. People who invest for capital gains have no choice but to sell their asset when they need to take a payment, which ultimately leaves investors with less flexibility. If you want to use that money to fund your son or daughter's college education, the investment must be sold. Think of this like buying an investment property solely for the appreciation. The property might be going up in value, but in order to realize some of that appreciation in your bank account to fund college expenses, it must be sold. A rental property that produces cash flow will provide profit on a monthly basis, regardless of whether or not the property's value is rising. Income investors don't need to be overly concerned if the value of their investment rises or falls on a short-term basis. Regular income provides more options in regards to when it's necessary to sell an investment. We can all agree that it's uncomfortable watching stock prices rise and fall dramatically day to day, wondering if and when prices will recover after a downturn. When relying primarily on dividends, You're provided the flexibility to wait out any poor markets. Dividend-paying companies tend to be older, stable, and established with plenty of money, enjoying a degree of immunity when economic conditions change. If your investments don't provide any cash flow and a situation arises when you need more money, you might be forced to sell your investments at a loss. For example, a capital gains investor might buy and sell a stock every year and use the gains to fund their mortgage payments. In contrast, a dividend investor might hold on to their stocks for the long term and use the dividend payments to pay their mortgage. Investing for cash flow and dividends allows you to benefit from steady income as well as enjoy profit from capital appreciation when and if you decide to sell. A quality rental property will generate income on a monthly basis as well as capital gains over the long term. Quality dividend stocks will provide income on a regular basis, usually quarterly, and the value of the stock will most likely increase over time. Investing with a goal of cash flow allows you to take advantage of both of these opportunities. Growth stocks that don't pay a dividend at all leave the shareholders hoping the price will increase as they wait eagerly for the day they can sell the investment for a satisfactory return. The best part about dividend investing and investing for cash flow in general is that there's no need to keep working or continuously buy and sell investments to maintain the income. Once a dividend-paying stock or fund is purchased, there's no further effort required in order to receive income. The payments will simply arrive without requiring you to lift a finger. On the other hand, capital gains requires much more effort. A constant cycle of buying and selling must be maintained to realize income. There's no way to earn income and use it to pay bills without selling. Dividends are a form of profit disbursement, so investors are essentially taking a cut of the profit on an automatic schedule. The profit payments, or dividends, are determined by the board of directors that run the company. There are no guarantees with any investing strategy. A company or fund could stop paying their dividends, their stock price could drop to almost nothing, or they could go bankrupt. A rental property could become worthless and stop producing income. However, income investing, or dividend investing, is much more stable than growth or capital gains investing. Money that keeps flowing in regardless of your daily activities means that you could be traveling, golfing, or simply sitting on the couch while payments arrive in your bank account. This passive investing strategy is pretty enticing when compared to a constant cycle of searching for properly priced investments, waiting for appreciation, and then trying to decide when it's time to sell, all while receiving no income. Income investing provides a higher level of financial freedom, as the income is truly passive once the stock is purchased. For investors who prefer to receive regular income without being pressured to make buy and sell decisions to earn money, dividend investing is something to seriously consider. Combine regular, stable profit disbursements with the fact that you can still have the ability to profit tremendously from capital appreciation, and you have a great investing style that's sustainable for the long term.